Hello traders, in this video we will be discussing the producer price index, that is the PPI report. Some of the areas that we are covering include what it is, when it is reported, why it matters to traders and investors, how it affects the market, and the best approach to deploy to effectively trade the PPI report. The first thing to note is that the producer price index, that is PPI, is a measure that simply reflects the change in price of finished goods and services that are sold by producers or are sold by producers. Essentially, it tracks wholesale prices, thereby indicating the fluctuation in costs for producers. The PPI serves as a lead indicator of consumer inflation. Typically, when PPI rises, it signals higher costs for producers, which are often passed to the consumer, leading to increased consumer prices. It is imperative that traders take note that the PPI is reported on a monthly basis, and this is usually around the middle of the month. As a matter of principle, a hot read in PPI data signifies a higher than expected increase in inflationary pressures, indicating a significant rise in the price of finished goods and services that are sold by producers. This could lead to bullish movement in assets like stocks, as it suggests a stronger economy or potential for increased profits, while it could lead to decline or bearish movement to assets like gold due to diminished value of non-interest bearing assets in the face of rising inflation. Overall, a hot read in PPI data is crucial for traders, investors, and analysts, and this is because it offers insights into inflation trends and can shape market expectations and investment decisions. Simply said, or for traders that engage in forex market, the US dollar and the stock market react bullishly to a hot reading, while the safe haven assets such as gold are bearish to a hot read in PPI report. On the other hand, a cold read typically denotes a reading that indicates lower than anticipated inflationary pressures within the economy. This may suggest a minimal, or it actually suggests a minimal or decreasing change in the price of finished goods and services that are sold by producers, which indicates potentially stagnant or even declining costs for producers. So how does market participants react to such news? In response to a quant read in PPI data, market participants might anticipate bearish movements in certain assets, including stocks, which is due to the potential economic slowdown or decreased profit expectations for companies. Conversely, assets like gold may experience bullish movements, and this is because investors often seek refuge in safe haven assets amidst lower inflationary pressures. Thus, a quant read in PPI data is significant as it provides valuable insights into the inflationary trends and can also influence market sentiment and investment strategies. It follows that traders should be aware that when the PPI reads indicate high inflation or when it's hot red, it suggests potential bullish movements in certain assets, including the US dollar and the stock market. On the other hand, when the reading suggests lower inflationary, that is when it's cold, it may lead to bearish movements in the same assets. More importantly, it is paramount to mention that the producer's price index is most effective when utilized alongside other economic indicators and data points as traders and investors make their trading or investing decisions. Typically, by analyzing the PPI in conjunction with relevant factors, market participants can obtain a more comprehensive understanding of the economic trends and also potential market movements, which should appropriately guide their trading decisions. Thank you for watching. Let us interact again in the next trading video.